You're probably listening to this episode because it's either tax season or you're just curious to hear some crazy tax loophole strategy for the rich. Well, congratulations, you're at the right episode. When it comes to taxes, it's such a drag. You know you have to do it. If you don't, you have to come up with some insane image in your head where the cops are just knocking on your door. Maybe there's some nerdy guy in a suit proving that you owe the government money. Well, that happens to me every year. And that's why in today's episode, we brought on our tax professional to answer our questions. He'll help us demystify taxes and offer practical advice on how to make tax season less taxing and more beneficial for your bank accounts. Whether you're an entrepreneur, a freelancer, or someone who just wants to understand how to optimize your taxes, this episode is for you. All right, let's jump into the intro.
1, 2, 3, 4.
Welcome to another episode of the Dapper Dollars podcast, where we answer your finance questions, but a bit with style. I'm Neil Bonser, joined by my co-host, George, and together we're diving into a topic that touches the wallet of every adult out there, taxes. So George, who do we have on today?
Well, before I introduce our guest, we kindly ask you to hit that follow or subscribe button to our podcast. This shows that you not only love our episodes, but it also encourages us to continue our mission, one listener at a time. Now, let's give a warm Dapper Dollars welcome to Neil Bonser. Neil brings years of experience in navigating the tax landscape, helping clients optimize their financial situations through savvy tax planning and execution. So with Neil's guidance, we would explore everything from understanding deductions and credits to mastering tax-efficient investment strategies. Neil, it's great to have you on the show. Welcome.
Hi guys, it's great to be here.
Neil, you have a very impressive background. I get it why George uses you as the tax guy. For our audience who don't know you, can you tell us about your background and how you got into tax accounting?
Yeah, sure. So I spent years in the corporate accounting world for some big companies in Atlanta and always had the kind of entrepreneur bug, always the desire to get out there. And it's just the corporate grind, getting burnt out with like the corporate accounting cycle and the politics. I took a leap and decided to open up my own tax firm. And so I help individuals and small businesses with their tax planning and maximizing tax efficiency. Been going at it a few years now, and it's going really well.
Nice. So let's just get into it, just because I know if somebody is listening to this episode, they might be on a rush and I just need some quick information. Then we can talk about other advanced strategies too. But let's talk about, let's say, like an ordinary listener who doesn't know, or maybe they're new to taxes, or they just don't know how to play the tax game. So a common question that they have is like, how do you explain the difference between a tax deduction and a tax credit?
Yeah, so this is kind of like the fundamental thing with preparing your tax return. So a tax deduction reduces your taxable income. So you from the various way you earn money, W-2, small business, investment income, all of these go into your total income. So a deduction will reduce that income just off the top. So a mortgage interest deduction or 401k, it basically said if you earn family income of 100K and you have a $10,000 deduction, your taxable income is $90,000. So a tax credit is different. They both reduce your total tax bill, but the difference with a tax credit is it's a like dollar for dollar reduction of your tax owed. So if you earned $100,000 and at the end of the year you owed 10, say, and you had $2,000 in tax credits, it reduces that 10 to 8. So it's similar result. The goal is to reduce total tax owed, but one's off of income and one is like just dollar for dollar off of the amount you owe at the end of all the calculation.
So let me quickly ask one thing. So the deduction, I think most of our audience understood that. So there's like the different tax brackets, right? And so it depends on what your salary is, you're on a certain tax bracket. Most of us were like, let's just say we're on a 22% tax bracket. And there is like that threshold, right? Between like whether you go from like 22 to 32, or you can be between the 18 to 22 or whatever that lower one is. Meaning like you can take advantage of these deductions, right, to get you down to the below threshold. So that way you're taxed less. So on top of that, it sounds like whatever tax bracket you're in, you're responsible for being taxed this much. But now you can have tax credits to reduce that amount that you're going to be taxed on. Is that
That's
correct?
correct. Kind of like the end result. So yeah, you're right. If you're close to a changing tax brackets, and the deductions will keep you in a tax bracket, or a lack of deductions could bump you up to the next tax bracket. So yeah, you're thinking about that correctly. The deduction will directly reduce kind of those brackets, what bracket you fall into with the total income earned of all sources. Where yeah, the tax credit is at the end. It's a direct reduction of like the end result, essentially. I mean, nobody wants to pay taxes, me included. So it comes down to coming up with the best strategy and utilizing tax rules, and even taking those tax rules to like the absolute limit. The Congress has passed these laws. The IRS enforces it. Like, there's nothing wrong with using the tax law as written to your advantage. And part of that is understanding it. And there's a lot, and there's some basics that individuals everyday tax preparers can do, and then there's some that you need a tax professional for. But yeah, I mean, you have to pay your tax. The IRS will eventually find you, especially if it's like a document. There's public, a brokerage is going to send a form to the IRS and to you. Your W-2 goes to the IRS. If you don't file and don't pay, that's bad news. It might take a few years, but they will track you down. But coming up with tax efficient strategy and utilizing those strategies, or maybe not tax avoidance per se, but like a tax wise strategy, and it's an ongoing process throughout the year or multiple years. It's just saying what's available for me to do. Is it worth doing? And then taking those credits and those deductions to your advantage. And those can change every year too, but that's really what it is understanding what you can do and doing it correctly. But yeah, tax evasion is bad news.
Okay, so you mentioned about tax evasion, right? And then the IRS will eventually find you. But like, how long is that? How long do I have of a time where I can, go change my name and then go run the country or something?
I think I still think they would find you. So if you don't file or commit fraud, like there's triggers for the statute of limitations. So typically it's like 3 years to get audited, assuming you don't commit fraud or do something. Like, there's a threshold if it's more than like 25% of your income that's misstated. But if you forgot to claim $500 in investment income, and it's typically 3 years. But yeah, I've never met anybody that successfully evaded that arrest for.
They're in jail. Right? That's why.
Yeah, right. So I'm a tax professional. My advice is file your taxes. I get a lot of people that are late, but file your taxes.
There might be people out there that might be curious. But okay, so this for the serious question. So I know you mentioned about there's no tax avoidance, but so I know there are though tax efficient investment strategies, right? So what are some things that you can share, like the juicy ones that people really want to know? And it's kind of like what you hear, the rich are always getting richer because they're able to do this, or these political leaders they have advantage because they really understand. And it sounds like you kind of have to know the rules and play the rules, but then it's how someone reads the rules to really make it work for you. So yeah, please feel free to share.
The biggest thing to do investment wise is like max out tax advantaged retirement accounts. I mean, the everyday person, it's like, if you can afford it, max out your 401k. That's a deduction like directly off of your income. And it's taxed when you pull it out in retirement. But I mean, that's your company matches it. It directly reduces your income that year. So there's basic things, and there's self-employment options. If you're a business owner, there's, self-employed pensions and IRAs and simple 401ks. There's lots of options, but I mean, that's the easiest thing to do to lower income and get retirement savings. But then there's other strategies. There's tax deferred accounts, or there are tax free accounts with like municipal investments and some other stuff. But the big thing that it comes down to is investment gains are taxed at a lower rate than ordinary income. They're taxed at a capital gain rate, and it's typically 15 to 20%.
And that's
for
long term,
like,
right?
Yeah, it depends on your income. If you're higher income, it's going to be 20, but for a super high income earner, that's lower than the 37% tax bracket. So these incredibly wealthy investors that you see, they're paid from capital gains. A hedge fund owner probably doesn't take much of a salary. They take the capital gains. So that's really, I mean, you're automatically getting a tax advantage there because most of your income is, and you're only taxed on it when you sell the asset and take the money out. So if it grows, you're not taxed right now. And then it's really just, a lot of it's working with getting a lot of self-education, I guess, or working with a financial advisor. But there's tax strategies. You want to be balanced, and you want to know your time horizon to pull out the money. If you need, if you're going to need money in the next 2 years for college or kids or a wedding, like you're not going to tie it up. You can't afford to tie that up in a 401k because you can't pull it out till retirement without a penalty. So you can do a brokerage account, and then it's just, how long is the money going to stay in there? If you sell it in less than a year, it's taxed in your tax bracket. If you keep it over a year, it's long term, so it's capital gain. So it's really understanding the tax, the time horizon, and then the tax effect if you do something with it. And some people have to pull money out of their 401k and accept a penalty. It just, there's no way around it. But just understanding, when you might need the money, and then a good strategy is balancing in all of these various options. Don't put all your eggs in one basket. And then, sometimes things happen, and just understanding what happens if I pull this money out. How am I taxed? And another big thing I see is you are going to be taxed on it. So planning, if you pull out $50,000, you can't use all 50. Like you can pay the tax at the time you pull it out, but I see some people that they spend it and then, they owe 10 or 15K on that money they pulled out. So it's really just being educated on the options and understanding the impact, of your decision.
And one quick thing. So there's a lot of information out there, and I like how you told us this information, because this is the important stuff. This is the it's kind of like the foundation of how people need to understand taxes. What about what you see on TikTok and the people talking about, oh, you want to get this Lamborghini because it weighs this certain amount, and then you'll see this tax advantage. How do you explain that, please?
I get this all the time, and there's so much bad information. And I'll admit, I've watched some of these videos and I get confused. I'm like, I don't think you can do that. I'm like, no, you can't. Look it up. Like, you can't. So the big one is that Land Rover, because there's rules on if it's classified as a truck, if it weighs a certain amount. But at the end of the day, this is what I tell people. If it's business, for business, you can take a deduction for business use. If you buy a Land Rover under your business, that's great. But if you don't use it for 100% business, you can't deduct 100% of it. You can deduct half of it if you use it half for business. But yeah, you see this stuff. I bought a Land Rover and I took depreciation and I fully wrote it off. It's well, some of it you did. And maybe he did. It's not correct to do. Maybe they, but I had a question about, if a client bought a yacht, and this was essentially like a boat on a lake. It was like a lake yacht, right? And if I have a meeting on it once per year, can I write it off? It's like, well, you can write off that day, like the one day of the expenses for the whole year. Yes. But there is a lot of confusion of if I take a trip to Hawaii and I have a dinner with my mother-in-law and we talk business, it's like, you can only take the deduction for legitimate business use. And there's some nuance if, a lot of medical conferences are at nice locations, so there's some of it, but just the general rule is if it's business related, yes, you can do it. If it's a car or a boat or whatever, it's like, you gotta take out the personal use out of the business deduction. I mean, really, and there's some different rules and some nuance, but at the end of the day, it really just comes down to, specific business use.
And can you demystify the whole weight thing? What does that mean? Is it because it's at a certain tier and there's a better deduction for like a truck, for example, compared to like a small size sedan?
Yeah, it's with depreciation. So it's one of the few cars that, and I don't know the exact weight limit, but it's one of the few SUVs that like weighs enough to hit that cap, almost like a work truck, right?
Yeah.
If you're a plumber and you have a work truck,
Yeah.
that's going to qualify. So it's almost like the Land Rover is heavy enough that it falls in this category.
Okay.
Yeah. So it's what they think is a loophole. But
So if I tune out my car, put like this heavy sub bass, and then get this massive heavy engine, weigh it up to like that technically could work.
that's right. Yeah, it's a work truck. Sandbags in the back and
Truck sedan.
Yeah, that's what I want to deep dive on the misinformation out there. Like, just mention TikTok videos and everything else. So what tax advice do you have for small business owners, people looking to start up and who have actually started businesses but don't actually know the right next steps as well?
Yeah, and I work with a lot of new business owners. So I think the most important advice I can give is to be organized and to implement an accounting system as quick as you can, like a QuickBooks or a Xero. And a lot of people, they don't understand, but you can work with a tax professional, but a lot of these, they've gotten so intuitive that even if it's just the expenses, some of the advanced stuff like depreciation on a work truck or something, it's not like, okay, that's different, but you're going to have some startup expenses that you can deduct or you can capitalize, but it's really separating the personal expenses from the business expense. Don't try to manage your business from your personal account. Even if you open up a separate account at the same bank, like the biggest thing is to separate business from personal so you can accurately track what you're doing. If you can implement an accounting system, and then it's really everything related to your business, valid business, the standard day-to-day stuff is a deduction. So you're going to have all the income earned and, office supplies and anything depends what you do. If you're providing a service, you're going to have less deductions. But if you're, a plumber, you're going to have a lot of supplies. If you're selling widgets, then obviously you're going to have inventory. So it really depends. But like pretty much any valid business expense, keep track of it. It directly reduces the business income. But you just have to understand what that is. There's no magic tax deductions. A lot of times I'll see people that, you can take part of your personal cell phone, like take half of your cell phone bill because you're working, 40, 50% of your life if not more. But I typically say take half. Some home office, if you're working out of your office, you can reduce some of the expenses. But it's really the biggest advice is come up with a system where you can be organized from the get-go so you can focus on your business. Don't manage your business from your daily bank balance. I see that a lot. Like if the more information you have, the better you can make decisions ahead of time. And it's common. I see it all the time. They're like, oh, can I do this? Let me check my bank balance. And that can be good for the first year or two, but to really make strategic decisions about the future, the more knowledge you have is better. And then understanding you are going to owe taxes on the income at the end of the year. And so probably the most prudent thing to do, at least once you get started, is to pay estimated taxes. So the IRS wants you to pay evenly throughout the year the tax you're going to owe. And most people, that's done through your payroll, right? Every paycheck. So that satisfies that requirement. But if you're a business owner and you expect to make a profit at the end of the year, you want to put something aside and submit it quarterly to the IRS and to the state that you live in to pay those taxes throughout the year. If not, there can be a penalty for, not paying throughout the year. And if you don't make much of a profit or no profit, it's kind of a moot point. The more income you make, the more kind of vital that is to understand where you are each month and then submit some quarterly payments. And I see a lot of business owners get in trouble with that, or contractors like 1099 contractors that don't pay any tax throughout the year. They get dinged, you're still going to owe it at the end of the year and they get dinged.
Yeah, it's important to separate personal and business. But what about like someone's a crazy shopper and us at Dapper Dollars, We also like to implement fashion in there. So what if somebody's there trying to look good and they want to look good for the business though? How do they consider that being a business or personal expense?
Yeah, that's kind of a gray area because the IRS says it's work related clothing or uniform, and it has to be worn strictly for work.
Mm-hmm.
So it kind of that's easy if you're in a job that requires like a uniform or a really dirty job or something where you're throwing away the clothes or I don't know. So it is kind of a gray area, and I get the argument of if you're a real estate agent, you have to dress as you wouldn't. So it is a bit of a gray area, but the letter of the law says business use only, can only be worn for business. So technically you shouldn't reduce it, but yeah.
And one thing I've really enjoyed speaking to you so far, Neil, is just how you're able to really make the technicalities very digestible. It just something I've really been enjoying. I do want to ask, so as we approach tax season, again, the refund check becomes the biggest buzzword. So what tips do you have for people not only preparing and filing taxes this season?
Well, I think the biggest thing, same as before, if you're a business owner, is start to get organized near the end of the year, and be proactive. If there's things that changed in your life and you need some help, like reach out to a tax professional or do some research, because once the calendar year changes, I guess with like an IRA contribution you can make into the next year, but a lot of stuff, once the calendar year changes, it's in the next tax year. So there's definitely be proactive, understand what's going on. But the most common thing I see is just understand all the statements you're going to get. Look at what you had last year. If you have investment accounts, make sure you get the statement. If you have an HSA, make sure you get these. These are the common things. Company stock is a big one because a lot of times, people work at a corporation for years and they reach a certain management level and they start to get company stock and don't realize, now I have a statement of stock transactions, and I've had people that didn't claim them because they didn't know. So it's really understand your total picture, start to get organized, know where to reach out if you don't get a statement from a brokerage or a bank, an interest statement or something. You got to reach out to them, because the kicker is those statements are also sent to the IRS, and it's not the end of the world. But if you made, I'm guessing if you made hundreds of thousands of dollars in the stock market, you're going to know where that statement is. But say you made a few $100s and didn't know, or you forgot about a bank account and made $62 in interest, the IRS is just going to send you a letter. It's not the end of the world. They're going to say, hey, you didn't claim your Bank of America interest. We've added it to your tax return for you, and you owe us $15. I mean, it's a lot of the IRS communication is harmless, but I think really it just comes down to being organized, knowing the stuff, and then understanding, the big decision for individual preparers is, are you itemizing, which means are you with all your deductions, charity, mortgage interest, state and local taxes, are you over the threshold of the standard deduction, which for a married couple is $27,700. If you're a single filer, it's $13,850. So you automatically get that off your income. And if you just take the standard deduction, you get it. So if all those deductions go over that, it's more advantageous to break out all these deductions. So, I mean, that's a big thing, understanding, if you don't, then all those deductions don't really matter. But if you are going to itemize, you donate to different charitable organizations. A lot of people donate to a church, is like getting those statements, because that can save you a lot of money. Non-cash donations, a lot of people clean out their basement and, give to Goodwill or something. Like you can deduct all that if you itemize. So those are important things that, an investment of a few hours can save you, on your tax return. So really just almost like preparing and understanding what you can do and then what you need, I guess, to make those deductions.
So you're saying like not losing your forms, or where your form will be, that good old that good old trick of people say is like, oh, my dog ate my homework or my dog ate my tax forms. That's not going to work, right?
Oh, it's that whole meme of you know, how much do I owe? And the IRS is like, oh, you have to figure that out. And then and well, I figured it. And it's like, no, you're wrong. We knew all along what you owed. It's like, why are we doing this exercise? But it's really like, and I tell people all the time, nobody likes to get that letter in the mailbox that says IRS return address, but most of the time, especially if you're not doing something like really devious, it's harmless. It's a information request or like hey, you had some mutual funds you didn't claim, adjusted their return. It's not the end of the world, but then you probably go in a database that you didn't claim something, then they'll check again next year. But yeah, it's really just understanding all of your income and then, making decisions that can help. Would a HSA, something like a health savings account, help you, increasing 401k deductions or dependent care expenses? You can contribute out of your paycheck to dependent care, and it's a pre-tax deduction. So there's like things you can do if you're paying childcare anyway, and your company offers dependent care, payroll deduction, then you should take advantage of it. So it's things like understanding what's available and how to go about it, and not just kind of filling out the paperwork and filing.
So quick thing. So I know I really appreciate how you're able to break things down in layman terms. And I love that. While we have you on, I really want you to explain to our audience some people have a really good year for investments or business, and then they got to pay their taxes on that. But then if they didn't have a good year this year, but then they have a better year. Can you explain like how that works? Like, isn't that what tax loss harvesting is? That you take your losses and then you can kind of reduce your taxes the next year when you have the gains?
Yeah. So really tax loss harvesting is almost looking at your accounts and saying, if you made a bunch of money in, stock one, and you hit the Tesla train or something early, and you had 4 or 5 stocks that had a loss or didn't do as well, you could sell all the stocks, and then the gain and the losses would net and lower the gain. So it's almost like taking the losses and putting it against the stocks that had a gain to lower, because otherwise it just sits there, I guess, is really the thing. If it sits in there, if it's a dividend stock, you pay tax on the dividends earned, but really that's it's called realized gain. Like that's the only income you're taxed on if you just leave the stock alone or mutual fund or whatever it is. If you sell it, then that's the tax event that triggers the depends on how long you hold it, the type of tax. So if you want to sell a stock, then you can, basically pair the gains and the losses to get as close to zero as you can. The other side of that is if you have a really bad year, say, with COVID, the stock market dropped and you needed money or something, so you had to sell stuff at a loss, you can only claim a total loss of $3,000 of the net, basically. So if you had $100,000 in losses, you cannot claim that against your income. You can claim the 3 to lower your income, but that loss sits there until you can use it. If you lost $50,000, it's sitting there, and the next year, the first $50,000 you gain, it's going to offset to zero. So I see that, or a lot of people, they'll inherit a house or something, or some asset that's sold at a loss, and it basically sits there until you can use up. So really, the next gain, the next couple of years, that gain you make is going to be offset by the loss. Is really the.
Can you please paint that into an example with numbers and all?
Sure. I one of the corporations I worked for was Home Depot, right? So if you had a loss of Home Depot, so say you're buying a house and you sell your Home Depot stock, and it was a loss of $10,000, and you had no other investments. It was just your only investment was the Home Depot stock. So you could put a stock market loss of $3,000 on your tax return, and it would lower your income by $3,000, and the other 7 would just sit there. And so the next year comes around, and maybe you made, you sold stock and made $5,000 in gain, you could use that loss that was sitting there from the year before and offset that gain. So your taxable income, your taxable investment income was zero. And then you still have $2,000 sitting there for the next year. So it's the same with like rental properties and some other business losses. Sometimes you can't take the full loss against your income, but you don't lose it. It just sits there to offset future gains. So really, if you're planning effectively, it comes down to you needed the money. That's why, or you didn't have an option. You needed to sell the stock at a loss and accept the loss, and you just have to wait and incrementally use that loss up until it's gone.
That's awesome. I appreciate that, walking us through that, because I know there's people who are kind of in the market and then they want to figure out what to do with their losses. And this is a great way to understand how to go about this strategy.
The other, there's kind of one issue to work through with that. You have to be careful of something called a wash sale. If you buy and sell the same stock within 30 days, you don't get to claim the loss.
Makes sense.
And it always takes a few years for really savvy people, for like the IRS and Congress to catch up. But at some point they realize everybody sells all their losses at the end of the year and then buys it on January 1st. They have the same position, but they got the loss, right? So they're saying, okay, if you do that, you have to wait 30 days. I think it's 30, but you have to wait a period of time to rebuy the stock, or you don't get to claim the loss. So and any financial advisor would understand this, but if people are doing the investing on their own, just understand there are some rules too.
And you're praying the price is like kind of hovering at the same spot within 30 days, and then you can get back in.
Yeah. So that's really the only downside if you're self-managing your investments, just to be, you can buy other stocks, but if you buy the identical stock, you can get yourself in trouble.
Wait 30 days, big tip. To kind of summing up, we've had conversations around like obviously how individuals interact with like, their tax planning, and small businesses to big corporations too as well. So from your experience, since you have been the tax guy, is one piece of advice you wish everyone just knew about taxes? Yeah.
The biggest thing, as much as people hate it, taxes are really a year-round event, a year-round planning. It's not just March. It's especially the more money you make, or if you have a business, like it has to be you have to visit it multi times a year. And whether that's just kind of looking at what's going on in your personal accounts or working with a tax professional, I mentioned paying the estimated taxes before, doing some tax planning. If you're a business owner and there's some valid expenses that you can do at the end of the year, like you might as well plan ahead. Or if you need to make a big purchase or sell a house or enter into a rental property or sell it, like these are conversations that, especially from my end, it makes tax time a whole lot easier if I know what's going on, instead of, March 1, you're telling me, oh, by the way, I sold my house, bought a beach house, and started a business. It's like, okay, and there's nothing we can do after the fact. So it's really critical if you're an investor, if it's just some investment income and you're, fairly simple tax return for the individual. The damage isn't as great, but for me, it's just understanding. You don't have to be a tax expert, but just some year-round planning, looking at stuff is the best thing you can do so there's no surprises at the end of the year, especially as you get involved with more stuff. Some of it's just like company stock. I see that a lot. Just, they don't have a CPA because they're W-2 earners and they have 2 kids and they just go to work. All of a sudden they start getting company stock, and there's a lot of stuff that starts happening. So, my advice is kind of be organized and plan ahead.
Yeah. And also kind of like you want to use that CPA who, like you're the guy who protects them from the damages.
There's so much to keep up with that, I have to do continuing education every year, but there's not stuff that the everyday person is going to want to keep up with or care to. And like we talked about before, there's just a lot of bad information out there, a lot of clickbait, TikTok. And it's like, it helps because if you sometimes you miss out on tax savings. It's not a huge deal. Like it didn't cost you money. You just missed out on maybe reducing your income a little bit. But if you make the wrong decision, it can cost you a lot in taxes owed. So it's really, it's hard to keep up with as an everyday person when you got life to think about.
That reminds me of that famous Schitt's Creek line when the dad is talking to his son, or is it like Dan Levy's he's like, oh, it's a tax write-off. It's just a tax. Like, what does that mean? Oh, it's the government's going to pay for it. So you want to make sure you're informing yourself how that works.
Well, people need to understand is you're still paying for something.
Yeah.
Like if you take a trip somewhere and it's you find a loophole and put some of it towards the business, like you're still expending the cash to go somewhere to buy something, and you're reducing, like you might save, whatever your tax bracket is, say 30% in your tax bill. But a lot of people want to do stuff because like you were just saying with that show, it's like, it's a tax write-off. Well, yeah, but I wouldn't spend the money if you don't have to. Like, why buy a Land Rover if you don't have to? Oh, well, I get a write-off. Well, you still spent $120K on a Land Rover.
Still got to make monthly payments.
Right.
You're not going to get away with that.
It's a tax savings. Yeah.
Yeah.
So that's, I see that a lot.
So Neil, speaking of like everyday things and everyday people and everyday life. So when you're not looking at W-2s or Excel sheets, what do you like to do? Like, what's your thing? How do you decompress and relax?
Well, I have two young daughters, so they keep me busy. So they're 11 and 8. So a lot of school events and a lot of Taylor Swift listening in the house with the wife and two daughters. They're huge Taylor Swift fans. But I'm a huge sports fan. I live in Atlanta and I went to Georgia Tech. So I'm a huge Georgia Tech fan and a huge Atlanta Braves fan. And I live fairly close to the stadium. So try to go to as many games as I can. But yeah, that's, and I live close to a trail that's it's an old railroad that they paved over. So I'll go out there and ride my bike and get some fresh air. Not much during tax season. I do my annual gain of 10 pounds for tax season and then spend the summer working it off. But yeah, I do stay busy, but it's great. And that's one of the reasons I went out on my own is, to kind of manage my own time with the family and spend as much time as I can with my daughters, my wife and daughters.
Yeah, you think you're going to see a lot of your clients writing off those Taylor Swift tickets this year for their businesses?
Valid business expense. They brought it to the Taylor Swift.
Right. Client and your daughter.
Yeah.
Hey, well, Neil, it was a pleasure to have you on. I learned a lot. I'm sure the audience learned a lot from this episode. I know you're the tax guy, so where can people find you and use your services as well?
So I don't have a lot of social media other than LinkedIn. My company name's Iota Financial, so iotafinancial.com. And then my LinkedIn page is connected to my name and Iota Financial as well.
Great. Yeah, and we'll be sure to post that on our comments in the description so that people can find you. Thank you again. And for our supportive listeners out there, thanks for tuning in. Your support and engagement mean the world to us. If you have other tax strategies you would like to share with our community, feel free to DM or drop a comment in the comment section on our socials or YouTube. And remember, if you found today's episode valuable, please leave us a review on your favorite podcast platform. Don't forget to hit the like and follow buttons and share this episode on your social media. You can find us if you search @dapper.dollars on Instagram and TikTok to spread the word.
Insights like this, head over to our website, dapperdollars.com, and also check out our blog for detailed show notes from today's episodes and much more.
As we sign off, don't forget to look good, feel good, and do good. Join us next time for another empowering episode.
And stay savvy, stay stylish, and keep chasing your financial goals. Bye, everyone.